2 decades ago, the average person would have had little to no understanding of what private equity was. At the time, it was a niche and largely overlooked corner of finance, often pursued by those who couldn't secure positions at hedge funds, where real wealth was believed to be created. However, due to evolving regulations, shifts in investor preferences, and increased liquidity, the private equity industry has expanded more than 20-fold since the year 2000. In this time, private equity has created billionaires, acquired millions of businesses, and developed a reputation that many now view critically. Originally, its appeal lay in its relatively small scale and discrete operations. But like a system that has expanded beyond its natural limits, the greatest challenge facing private equity today is the industry itself. Acquisition opportunities have become scarce, fee structures are increasingly difficult to justify, and returns are failing to compensate for the associated risks. While it may seem like a problem affecting only the wealthy, the mechanics of private equity are deeply intertwined with the broader economy. The industry functions by borrowing significant sums through complex business structures that rely on continuous growth. If that growth slows or stops, trillions of dollars in leveraged loans could default, creating a ripple effect that impacts ordinary individuals. Despite growing concerns about its effectiveness, private equity continues to attract capital. Companies owned by private equity firms are statistically more likely to face bankruptcy. A notable example is Red Lobster, whose financial troubles are less about marketing strategies and more about its entanglement with private equity practices. The core of the issue lies in how private equity operates. At its simplest, private equity refers to investments made in companies or assets not listed on public markets. This can range from small-scale investments in local businesses to large buyouts executed by specialized funds. These funds pool capital from wealthy investors and institutions, supplement it with minimal contributions from the firms themselves, and then leverage additional financing to acquire entire companies. Once acquired, these companies, often profitable and operational, are encouraged or required to take on significant debt to pay dividends back to the private equity firm. This structure enables private equity partners to control billions in assets with minimal personal investment. Furthermore, the firms are typically not liable for the debts of their portfolio companies, insulating themselves from financial fallout. This model allows private equity firms to use existing assets as collateral to secure even more financing, commonly referred to as net asset value loans. Because these loans are layered atop existing debts, the practice is often described as leverage on leverage, highlighting its compounding nature. Even the initial capital contributions from investors are frequently financed through debt due to favorable tax treatment. To add another layer, secondary funds exist to purchase stakes in private equity firms from early investors. Although regulations are intended to prevent these secondary funds from using borrowed money, in practice, many of their transactions are also debt financed. This has led to a cascading structure where debt is used to acquire companies that are already leveraged, generating returns that are then used to qualify for further borrowing. It is a system of debt built upon more debt. The rise of private credit firms has further amplified this dynamic. These entities specialize in lending to private equity firms and their portfolio companies, and their role has grown rapidly, now accounting for over $1.6 trillion in lending within the United States alone. Because they are not formal banks and deal with private companies, their operations lack transparency, making it difficult to assess the full extent of their risk exposure. The entire cycle has created immense wealth for those working within the system, but much of that capital ultimately originates from ordinary investors and public funds. As a result, it is critical to understand how such financial structures operate, especially if market conditions reverse. Historically, long-term investment performance has shown that it is nearly impossible to consistently outperform public markets. Notable exceptions exist, such as Warren Buffett and Jim Simons, but they are rare and relied on pioneering unique strategies. Extensive data indicates that most funds which outperform in one period tend to underperform later, especially after fees are accounted for. This pattern, when repeated, can lead to significant wealth destruction. Private equity funds charge some of the highest fees in the financial sector, often 5 to 10 times more than actively managed public funds. Despite knowing this, institutional investors and the wealthy continue to allocate large sums to private equity. The original appeal of private equity was its ability to outperform public markets by investing in overlooked businesses and applying operational improvements. These firms would take over small local businesses, improve marketing, optimize finances, and implement strategic changes that the original owners may not have had the expertise to execute. However, as private equity gained popularity, the market became saturated. In the early days, firms could acquire businesses at 2 to 3 times their annual earnings. Today, similar companies often sell for 5 to 10 times earnings, dramatically reducing the return potential. This has forced private equity firms to extract more profit from their portfolio companies, often by taking on more risk. Additionally, many firms began flipping businesses among themselves at rising prices, creating a feedback loop that inflated perceived returns. This cycle attracted more investment, which enabled more borrowing and further price increases. Eventually, when quality acquisition targets became scarce, firms turned to riskier or less stable businesses, prioritizing resale value over long-term viability. The broader economic environment also contributed to the industry's success. Low interest rates and a high volume of business sales created favorable conditions. However, those conditions are changing. Baby boomers are retiring and selling their businesses at an unprecedented rate, increasing supply. Meanwhile, small business owners have become more informed and capable, reducing the need for external management or restructuring. Investor sentiment is also shifting. New commitments to private equity have dropped by 35%, and 2025 is projected to be the weakest fundraising year in over a decade. The lack of transparency in private valuations means that firms often sell their best-performing assets while retaining the underperformers, making fund performance appear stronger than it truly is. As firms struggle to sell off weaker assets, the pool of bad investments grows. If new capital inflows continue to decline, the system faces a serious risk, as many private equity firms rely on continual deal flow to repay existing debts. Major endowment funds, including those from leading universities, have begun selling off their private equity stakes, sometimes at discounts, further highlighting the liquidity challenges. A logical response would be for private equity firms to focus on improving their current holdings and accept lower returns temporarily. However, many are constrained by the massive web of debt they have built. If they cannot flip businesses quickly enough, they may struggle to meet their financial obligations. One sector that has thrived amidst these challenges is distressed debt. Funds dedicated to lending to troubled businesses have raised over $21 billion, indicating rising expectations of widespread defaults. If the system falters, the impact could extend beyond private equity. Trillions in securitized loans could threaten banks, pensions, and everyday investors. Many of these debts have been packaged and sold in layers with different risk ratings. While this is not as structurally dangerous as the mortgage-backed securities crisis of 2008, a poorly managed private equity downturn could still severely disrupt the small business economy, just as the subprime mortgage collapse upended the housing market. This assessment only covers the financial risks. Unfortunately, the broader social and economic consequences of private equity's rise and potential fall are even more concerning. Thanks for watching InvestingFlix, where smart money learns smarter moves. Subscribe for more insights that grow your wealth.